Hello and good morning, everybody. Welcome to the third webinar from Golden Pie. I'm Abhijit, and today we are going to discuss on a very interesting topic, and that is my investment safe with bonds? See, this is a very common question that we get to hear from first-time investors in bonds, or even from certain investors who have already invested in them. So let's try and understand deeper around what is the safety around investment in bonds today. The various areas that we'll be covering today are, first, we'll examine a couple of key features that signifies the safety level in bonds. Then we will see at few entities that are associated with the bonds life cycle, right from issuing the bonds to payment of interest in a timely manner to investors, to finally repaying back the principal amount to investors. Then we'll touch upon the pertinent topic of how to sell bonds or how to liquidate bonds before they mature. What are the process steps over there? What are the things that we should be aware of, right? So that the whole process is safe and secure. And lastly, what is the kind of protection mechanism that is there in the financial markets today that protect bondholders' interests in the worst case scenario of a default? During the course of this discussion, whatever questions you have, there's this Q&A section at the bottom of your Zoom panel. You can write down your questions. At the end of this presentation, I will take up the questions and answer them to the best of my abilities. I hope that by the end of this discussion today, I would have been able to share something valuable with you and show the safety level in bonds properly so that you can take your first fruitful step towards fixed income investment. Like all other times also, today's webinar will have a couple of interesting polls, which I'll show the results culled from our audience today, and we will take it forward accordingly. So let's get started. Let's begin with the first poll of the day. The question is the investment in bonds and debentures safe? How many of us would say yes versus let's see how many of us say no? Time's almost up. I shall end the poll now and show the results. Okay, I have ended the poll and here are the results. A resounding 67% of us have mentioned that bonds and debentures are safe investment, and around 33% have said that they are not, right? So it's 2/3 versus 1/3. So understandably, majority of us understand the safety level in bonds, which is a great news. Let's begin our discussion. The first area that I'm going to cover today are some of the key features that are built into every single bond tranche and that we should be aware of to understand the level of safety in them. The three features are: number one, whether a bond is secured versus unsecured; number two, whether it is a senior or a subordinate bond; and number three, whether it is a tier 1 or tier 2 paper. Let's understand them one by one. A secured bond is one wherein the invested money of the investors is protected or securitized by assets or some cash flow that the company will receive in the future. In the worst case scenario, if something happens to the company, it's not being able to pay, these assets will be reserved for liquidation, and then the money from that will be used to pay off the bondholders. Or if it is a cash flow that has been earmarked for payment to the bondholders, then in worst case scenario, the cash flow generated will be used to pay off the secured bondholders. As an example, over here, we have called out one bond tranche from Navi FinServ. It's an NBFC, and we are seeing at an NBFC bond. Now, as you can see in the highlighted section in yellow, this bond is securitized with the debt book of the company, which means the company would have invested in certain things which are of good quality. The payment from that will be kept completely reserved for paying off to bondholders in case there is an issue. So that's like the kind of securitization built in. With this, there are unsecured bonds, which are not protected or securitized by any asset or any cash flow of the company. Understandably, that means In the worst case scenario, there isn't anything earmarked separately for payoff to these bondholders, which means there is an element of risk there in that scenario. Because of this reason, we have to note that unsecured bondholders having higher level of risk will be paying higher returns in general than secured bonds, which are way safer because of the securitization, and hence they will be giving lower yields. I would want to definitely call out one point over here, and that is an unsecured bond essentially does not mean an unsafe bond. Unsecured is a financial term meant to represent that there is no asset backing of this particular bond. But that essentially does not mean that it is unsafe. In fact, an unsecured bond from a very good quality company, which has got awesome financials, very good quality management, would any day be much safer bet to invest for fixed income than secured bonds of a B grade or a C grade company. So essentially, it's underlying company's bonds that matter. The next area that we'll discuss is around senior versus subordinate bonds. And what do they mean? It is, in the worst case scenario, once again, the senior bond holders will be paid first, and then whatever outstanding money is there would be paid proportionally to the subordinate bond holders. In short, this is the pecking order or the payment order in which, post liquidation of a company, bondholders will get their money back. As you can see, the senior secured bondholders will be the first ones to get money, and unsecured subordinate bondholders will be the last ones to get money. And the final ones, if any fund is still left back, will go to equity holders, equity being the highest risky asset. Third, let's look at tier 1 versus tier 2 bonds. There are very specific category of bonds that are issued by banks and certain NBFCs under the RBI guidelines. Now, tier 1 and tier 2 bonds are used by these banks and NBFCs to raise capital for their capital needs. And in fact, they are ranked in safety just above the equity of the entity. So in worst case scenario, once again, if a bank, is getting liquidated, right, then what is the order in which payments would be done to the debt holders? First, it will be deposit holders whose money is secured till max up to 5 lakhs as per the RBI guidelines. Then would be the secured debt holders or secured bond holders, then unsecured bond holders, then tier 2 and tier 1 capital bond holders, and then finally shareholders. So this is the order in which payment would be done in the worst of the worst case scenario. Understandably, because tier 1 and tier 2 are just above equity, so these bonds in general pay very high levels of fixed returns. So I'll just pause and quickly recapitulate the things that we covered right now. First, we understood what are secured versus unsecured bonds. Then we learned about senior versus subordinate papers. And then we became acquainted with tier 1 versus tier 2 bond papers and the commensurate risk and return levels that we can expect from them. Now, with this, let's move on to the next poll. And here goes the second question. The question is, according to you, which of the following do you think is correct according to your understanding? First option, government bonds are safer and provide higher returns than fixed deposits. Corporate bonds provide higher returns and are safer than fixed deposits. Corporate bonds are safer than mutual funds, third option. And final ones are corporate bonds provide a higher return than FDs of private banks. So the first option is FD of PSU banks. And the last question's option is FDs of private banks. All right. Time's up, folks. And here are the results. 57% of us have rightly said that bonds, government bonds, the government securities which are issued by Reserve Bank of India are safer and provide higher returns than FDs of the PSU banks. In fact, the 10-year government security returns uh, till last week itself was around 7.5%, whereas the FDs of public sector unit banks is anywhere between 5 to 6.5%. A 30% have mentioned corporate bonds provide a higher returns and are safer than FDs of private banks. 27% of us have said corporate bonds are safer than mutual funds, and 53%, which is the second highest number of people saying that corporate bonds give better returns than FDs, but are not safer than the FDs of the private banks. Let's stop the poll now and let's return back to our discussion. Next, we are going to examine the details of two specific entities who are involved in the bond management life cycle, which means issuing of the bonds, making payments to the bond holders, right, in a timely fashion, resolving issues. We will get to understand two of these critical entities. And they are, number one, the trustee, and number two, the registrar. So what are the responsibilities, or what do they do? The role of a trustee is a very interesting one. Why? Because the bond issuer, when it has to issue a bond, it has to designate a trustee whose sole responsibility is to protect the interest of the bondholders. So in case of any issue, it is a trustee who is going to step in and would follow a certain code to resolve the problems. Apart from this, there are a lot of critical activities which the trustee does. Two of them mainly being performing the registration of the bond issuer, the bond holders, ensuring that the units get transferred to the bond holders to their correct demat accounts, and scheduling of payments of coupon and the principal amount that needs to be returned back to the bondholders when the bonds mature. Here are some of the examples of the popular trustees that we have in a country. So some of them are like Axis Trustee, IDBI Trustee, Catalyst. As you can see, these are some very well-known large entities, and they do their work very diligently and understandably. With this kind of an entity overseeing the bond issuance and payment process, there's a high level of safety and protection that gets built around bonds. Next, let's understand the role of a registrar. In simple words, a registrar is like an accountant. The registrar actually keeps track of who are the current investors when the bond gets issued for the first time. Then bonds get bought and sold in the secondary market. So it keeps a tag or an information of records of all the current investors who are holding the bond units for any given bond tranche. The registrar then uses this information to be shared with the trustee for the trustee to execute its responsibilities. And here are a couple of the most popular registrars in the country. Link Time India, which typically is a registrar for almost all kinds of issuances. Then there is Integrated, and then KFintech. So here's an example of a bond issued by Ugro Capital just last year itself. So it was through an NCD IPO process in the month of November 2021. As you can see, the registrar and transfer agent for this specific bond tranche of Ugro Capital was Link Time, and Midcon was the debenture trustee for this issuance. There are a few other entities also. Equate, who was a rating agency for that particular tranche. Now, with this information, let's now decode what actually happens as a process in payment of interest by the bond issuer to the bond holders. What is the process that that happens behind the scenes? This definitely would give us a lot of clarity into how well structured the payment process is. Once again, signifying the level of smoothness in activity, operational efficiency, and safety, which is built around bonds and debentures. First, let's understand quickly a concept known as a record date. So, a record date is essentially a date 15 days prior to an interest payment due for a bond. On this date, what happens is the registrar actually takes out the information of all the current bondholders, their bank account details, the demat details, their physical addresses, and this information it then shares with the trustee. Now, one important thing to note over here is that from the duration, from the record date till the day of payment of the coupon, this period is termed as a shut period. What this means is, if there is a bond transfer of hands that happens, let's say I sell off a bond during the shut period, and let's say 10 days are left back to a buyer, the 10 days of accrued interest that the buyer should be getting, he is not going to get it in reality. The next coupon payment, I'm going to get it even though I'm a seller. In short, the buyer for this reason will be paying negative accrued interest to me as a settlement amount. We will see the details of why accrued interest is negative, and how does it impact the valuation in a session that we can take sometime later. But for now, what we should keep in mind is, if I am buying a bond during the shut period, my accrued interest will be negative. So the overall settlement value that I have to give will be on the lower side. Now, once the registrar has given the information to the trustee for the bondholders regarding their bank accounts, the physical addresses, number of units they are holding, the trustee evaluates the total amount of interest that needs to be paid to all these bondholders, and then ensures that the funds becomes available with one or more of the scheduled commercial banks that it gives the responsibility for money remittance. Then the registrar passes a kind of a permission to all these banks to start remitting the funds to the bondholders' bank accounts associated with the demats. And this payment happens on the coupon payment date, as we know it. Now, the payment actually happens, majority of the part happens via direct online or through the NAF facility, or RTGS and NEFT. In certain of the very corner cases wherein, let's say, the bank could not transfer the funds to the bank account of a bondholder, in that case, essentially, the registrar would issue a payment check in the name of the bondholder, and that will be sent to the registered address of the bondholder. So it would be a good practice to actually keep the details of our bank account and our physical mailing addresses updated in our demat, right? Just before the interest payment due date is scheduled. Now we will pause once again to just recapitulate what we understood. So we covered two entities, the registrar and the trustee, the role of protection that they actually play in case of any issue, and how they manage the entire fund flow from the bond issuer to the bond holders for coupon payments, as well as the same process followed when the bond matures to return back the principal amount. Point to be kept in mind over here is that if I have got an issue regarding my interest payment, I can always write to my registrar and trustee, and they will take up the steps necessary to resolve the issue. Let's move on to the third poll of the day. And here goes the question. For a given company, which category of bonds issued by it will be the safest and hence give the lowest returns? Is it senior and unsecured bonds, subordinate and unsecured bonds, secured and senior bonds, or last option, secured and subordinate bonds? Clock has started ticking. Okay, 10 more seconds to go. 9, 8, 7, 6, 5, 4, 3, 2, and 1. and I end the poll. And let me share the results. An overwhelming majority of 84% has said that senior secured bonds would be the safest, and hence commensurate with a high level of safety, they would be giving the lowest returns among the other varieties of bonds. And that is the right answer. With this, let's return back to understanding the next topic. This is a very pertinent topic because most investors come up with this question, and this is something which plays in the minds of people before they make an investment. Will I be able to liquidate my bond before maturity? Will I be able to sell it? So let's understand the means through which it can be done. First option is, for listed bonds, we can always try and sell off the bonds on the exchange, which is BSE and NSE. That's number one. And then second option is, we can get in touch with the organization from where we purchase the bond, be it my broker or a wealth management institution or Golden Pie, and talk to your relationship manager that I want to sell off my bonds. These are the two ways of doing it, right? Now, let's try and understand that what is the process of selling once I go through a relationship manager. My RM is supposed to get back to me with a buyer and with a buy quote. Once I have accepted that I'm willing to buy, I'm willing to sell the bond at that price, what I have to do is I have to fill up a DI slip, which will specify number of bond units that I want to sell, and I want to transfer it to ICCL. I fill that up with my RM and submit it to my broker. That's it. The very same day, the buyer will also transfer the funds to ICCL, and it will be credited to my bank account associated with my DMAT on the very same day. So that's all the process is about. And here is a quick view of how a DI slip looks like. A DI slip is like a checkbook. It's only that it is given by your DMAT provider. So if it's your broker who is your DMAT provider, you should get your DI slip and keep it handy in case you want to sell off your bonds. So as you can see, there is a well-defined process of being able to liquidate the bonds. Bonds are, sellable entities that can be sold off before they mature itself. So there is no lock-in concept in bonds. That is a big myth which exists amongst investors who haven't invested in bonds. But then there are two risks if I try to sell my bond before maturity, and it is good to be aware about them. The first is liquidity risk, and second is the interest rate risk. Let's examine them one by one. Suppose I have a house and tomorrow I want to just sell it off because I need my capital immediately. There would be a question whether I can get a buyer, and even if I get a buyer, am I getting the right price, right? So that is the point, that I'm not being able to sell off my house or liquidate it quickly, right? The same risk remains when I want to sell off my bond. When I'm trying to sell off, one, I should be able to get a buyer. Number two, the buyer or the buyers should be willing to give me a price with which I'm willing to sell off, right? So that's liquidity risk. However, if I hold my bond till maturity, this risk doesn't come in, number one. And number two, when I invest in bonds which are well rated from good companies, the liquidity is higher than poorly rated bonds. Next, interest rate risk. This is very relevant for today's discussion because interest rate risk is a risk which I will encounter in case the interest in the market goes up and I'm trying to sell my bond then. Like yesterday itself, RBI hiked 50 basis points, right? So the interest rate went up. Now, next week, if I want to go ahead and sell off my bonds, there's a possibility that the interest that bond is giving in the secondary market has also increased. And as we know from from a lot of our previous discussions, that the returns from bonds are inversely related to the price of that bond. So if I want to sell it next week, my bond returns in the secondary market has increased. So the price that the bond is commanding in the market has come down. So I might have to sell it at a risk, sell it at a loss, right? Reverse scenario will happen if the interest rate went down and I'm going to sell the bond in the market. I can be making a capital gains. Now, point to note is that because of this increase in interest rate in the market, the secondary market bonds and even the new ones which will be coming in will start offering greater returns. So it's a great opportunity for first time investors to invest into bonds because they will be getting more returns than it would have happened before this rate change. Now let's touch upon the worst case scenario. So we have seen that we should be aware of certain features about bonds for safety versus the returns. Number one. Number two, we saw how is the process of fund transfer managed by the registrar and the trustee, the operational steps behind it. Number three, we saw what is the process of liquidating the bonds or selling them off before maturity. And now the last topic that we'll cover for the day is in the worst case scenario, if a bond defaults, then what is the protection mechanism which is built in to protect the interest of the bondholders? So in this worst case scenario, investors actually approach the trustee, and with a certain majority, once the trustee sees that investors want a resolution, the trustee immediately sets into action trying to identify means to solve the default issue. Now let's say the trustee is not being able to quickly, then it actually takes forward the case to a government agency termed as the Insolvency and Bankruptcy Board of India, IBBI, that oversees the insolvency and bankruptcy code in the country. This is a very powerful entity which consists of members from the Law Ministry, the Finance Ministry, and certain members from the Reserve Bank of India. Right. So it's a very well-defined, strong process which kicks in with this to resolve the issue of default. And then, if after a certain duration of time, the default, the resolution process is not working out, then it moves on to an even higher body, which is termed as a National Company Law Tribunal, who looks at liquidating the assets of the company and paying back the debt holders. And then finally, this is the final entity which takes up the case, which is in the extreme cases, it would go to the NCLAT or the National Company Law Appellate Tribunal. As you can see that there is a very robust system of resolving the default of any bond in the financial markets today. It might take a bit of time, but it is very well defined. And because of this, what happens, the level of safety or the level of protection that is given to bondholders, as can be seen, is significantly higher, making bonds a relatively safer asset class. Now, we have seen the entire journey of bonds with respect to the features, with respect to payment, selling off, the default process. Now, finally, let's look at the reality. And by that, what I mean is, what are the outstanding number of corporate bonds as of date? It's around 30,000 corporate bonds that are existing in the market. When I say 30,000 corporate outstanding bonds, it means any bond that has got a unique identification number termed as the ISI numbers. So there are around 30,000 such outstanding bonds in the secondary market. Around 40 lakh crores have been raised till date through all these bond issuances. And this is data till July 2022. And out of this pack of bonds, around 16,000 have a rating of AAA to A rated. As we had understood in one of the previous discussions, that AAA rated to BBB rated bonds are regarded as the investment grade bonds, and bonds below that are termed as junk grade bonds. So this good quality bond, which is AAA to A rated, right? The good well rated bonds, they are 16,000 approximately in number. Now let's see what has been the default ratio till 2021. Total number of such unique bond ISINs that have defaulted amongst this pack of AAA to A rated bonds is 15 out of a total sample size of 16,000, right? making the default ratio less than even 0.1%. So as you can see that, though there are certain risks involved in bond, in reality, one, the default probability, the default ratio, the default rate is very low. And number two, it's a highly regulated financial asset with a lot of financial watchdogs closely monitoring and looking at this space to protect the interest of the investors and allow a smooth operating process, right? So with that, we come to the last poll, after which basically I'll start picking up the questions one by one and I'll try to answer them. In this last poll, we will actually have two questions, right? So here goes the first one. Parameters that you should definitely look into. So that's basically the theme of the questions. And the question is, while choosing a bond, what parameters should you definitely look into the bond to consider its safety levels? And it's a multiple choice question, right? Should you look at only credit ratings? Should you look at past 5-year financials of the bond issuer? Should you look at only whether the bond is senior and secured? Or should you go by whether the company is a popular one doing a lot of advertisement, a lot of, grabbing a lot of mind share of investors, basically a popular brand? Time's almost up, guys. So 5 more seconds. Time's up. So I'll end the poll now and let me share the results. Well, you can see the stats before you. However, the understanding is that we should look at multiple of these parameters and not just one. We should look at the credit rating. We should look at the financials of the bond issuer, the past 5-year performance, and whether the bonds are senior and secured, right? A couple of this will actually help us in understanding the safety levels and not just one parameter. So I'll stop sharing the results and we'll move on to the last question of the day. And the question is, if you have to choose a bond, which of the following would you select to diversify your portfolio, right? So will it be unsecured subordinate NBFC bonds with A+ rating, but with returns of 12%, senior secured bonds with AA rating, and which will give around 9-ish percentage, or senior secured AAA rated bonds with a return of around 7.9 to 8%. We'll have 5 more seconds to close the poll. And time's up. So here are the results. 23% of us have said that we would invest in unsecured subordinate NBFC bonds of A+ ratings with 12% returns. 76% of us, majority of us, have said that we will invest in senior secured AA rated bonds yielding around 9%. Around 46% of us have said that we will be investing senior secured AAA rated bonds with a modest returns of around 8%. Well, it depends upon the persona of the investor, the safety level one is looking at in diversifying the portfolio, right? So it's an individual choice. Okay, so with this, we come to the end of the presentation that was there. Now, I will pick up the questions one by one and I'll answer them. Now, before I move there, I will put up upfront that, the overwhelmingly large number of questions which we have today, and I don't think I'll have enough time to address them. But what I will try and do is find out the common questions, give an answer, and if the ones which are getting left out, we'll definitely compile the answers and share it with you later on. The first question is from Abhinav, and he asks, is the amount invested in section EC capital gains bonds By EC, I think he means 54 EC, capital gains bonds, with a 5-year lock-in period, closable prematurely. Good question. 54 EC bonds are, though they carry, the term of bond, they're actually deposits which are, issued by NHAI or REC. So they are really not bond papers in general. In reality, they are like deposits, and no, they cannot be closed off prematurely before 5 years. You have to keep it holding till 5 years is over, post which you'll get your money back along with the overall interest. Okay. The next question is from Mr. Krishnan Subra, and he asks, good morning, Golden Pie experts. I am an NRI living in Gulf. I wish to know if there are any bonds with cumulative payout options, as I do not need regular income now, but might switch to regular after I retire and settle in India. I also want to know if I can invest through NRE account, in bracket planning to retire soon, as I do not have India income. Okay, that's a great question, and this is NRI specific question. We will cover this topic in details in a specific session dedicated for NRI investments. But to Mr. Krishna's question, here's a quick answer. Yes, there are cumulative payout options available for certain bonds that one can invest in. But net, what an NRI investor should consider is that some bonds out of the whole universe of 16,000 AAA rated bonds that I showed, corporate bonds, are NRI investable. That means NRIs are allowed to park their money in those bonds, right? It is a subset of the total set of AAA to A rated bonds. Not all bonds can be invested in by NRIs, number one. Number two, the investment has to be from an NRO bank account, and which has to be associated with a non-PIS demat account. That's the overall structure one has to follow. And the reason is that, taxation designs say that the interest income that you get from your bond investment should not be repatriable outside India, right? However, this is a general understanding. You can always get in touch with your tax expert or tax consultant or advisor, and you can figure out your ways, the appropriate ones in which you want to move ahead. The next question is from Tarun Patel, and he asks, how safe are state government bonds like UP Power Corporation or Andhra Beverages? Okay, that's an important question, because these bonds have a specific clause which is laid out in their information memorandum, and that clause is unconditional, irrevocable guarantee for principal as well as the interest payments. That is something that is written in the information memorandum of these papers itself. Now, the state is putting in its security against these two bonds, right? The respective states, right? So I cannot advise on the level of safety of this bond. That's difficult. I don't think anybody can. But this is like a guarantee which is given by the state government. So if the state government is good, solid, of course, the bonds backed by the state government would also have a good level of safety. That would be the general understanding. I'll club up a couple of questions which are from a couple of our NRI investor friends over here. And the questions are, touch upon the tax implications for NRIs and residents. And can NRIs invest? How can NRIs invest in bonds? Is it through the NRO account? To the answer for the bank account that can be used by NRIs, yes, it has to be through the NRO bank account, and you will have to hold the bonds in your non-PIS demat account. And yes, NRIs can invest in a certain section of bonds termed as a NRI investable bonds. Now, coming to the taxation part is something that we will cover in details in a later session. But net, what you can consider is that you can discuss with the tax consultant regarding your tax positions, because different NRIs from different countries would have different kinds of tax implications. So that would be a very subjective case. For resident Indians, the way the taxation works is there are two components, two getting taxed on my bonds. One is the regular interest income which I'm earning, which will be taxed as per my tax slab. The other one is if I sell a bond before maturity and I make capital gains, then if it's a listed bond, then if I sell it after 12 months, I'll be eligible for LTCG, which is at 10% without indexation. And if I sell it before 12 months, it'll be as per my tax bracket. For unlisted bonds, the holding period for short-term capital gains taxation is 36 months. If I sell it off before within 36 months an unlisted bond, and my capital gains then will be taxed as per my tax bracket. If I'm holding beyond 36 months and selling off, then it will be at 20% without indexation. That's about it. Moving on, plenty of questions on taxation benefits from the bonds. So, a lot of these questions are similar in nature. Uh, uh, this is a bit of a subjective question. It's from Mr. Ravi Shankar, and he asks, I'm just retired and looking for long-term investment in bonds to sustain my life. Is this a good idea in terms of returns, inflation correction, and safety? Uh, Definitely, bonds are one of the popular fixed income options beyond FDs for investment. Bonds definitely come with their own set of risks. So, I will not be stating whether it is 100% safe and everything is well governed, and I can go ahead and make an investment in any bonds. Rather, what I can definitely say is, if I am to retire, I'm retiring and I want to put in my corpus in bonds because they are paying good returns. I will consider uh, A-rated bonds from public sector units, and which have got good financials and with a lot of government holding in them, because then the safety factor increases multifold. Right? Safest option for me would be government securities or GSECs, which are the government bonds issued by the Reserve Bank of India on behalf of the central government. Of course, then there are state government bonds as well, which are also sovereign guaranteed by the states, and they're termed as SDLs. So every state has got its own, state bonds, which they keep on issuing from time to time. So in a nutshell, whether to invest in bonds, definitely that's something that you will have to consider, considering the various safety parameters that we discussed during today's discussion. Again, a host of bonds, a host of questions from NRIs. Here's a slightly different one from Mr. Nitish, and he asks, state government owned bonds are secure by RBI like GSEC, state government bond rating review every year or only at the time of launch? Okay, if you're asking the question whether, let's say, the state of Karnataka issues bonds, right, and they're termed as state development loans or SDLs, are they secured by RBI like GSEC? They are secured by the state government, but just like GSEC, they are sovereign rated, which means they are above AAA rating. So it can be understood that, yeah, they would have a high level of safety in them, but they do not come with any rating. They are understood to be sovereign in nature. That means they cannot default. That's the understanding, right? And then next question is from somebody who is an anonymous attendee. The question is, suppose I'm new to invest in RBI related Government of India bonds. Now I have two bank accounts, namely IDBI and Axis. Can I invest through two different banks? I'll just understand the question once again. I'm new to invest in RBI related Government of India bonds. Now I have two bank accounts, namely IDB and Axis. Can I invest through two different banks? Yes, certainly you can, right? Every investment into the bond will be a separate one. So you can definitely use to do different bank accounts to pay for your investment. Now we have got a theoretical question, probably from the same gentleman or lady. And the question is, what is the difference between bonds and debentures? See, theoretically speaking, bonds are debt papers which are issued normally by the central government, the state government, or the PSUs. And debentures are the ones which are exclusively issued by corporates, which is like non-government entities. That's a theoretical definition. But in real life, in all reading materials in newspaper, you will see bonds and debentures being interchangeably used. That's a reality. Another thing is that from a theoretical standpoint, bonds are typically secured by certain assets. Debentures, on the other hand, may be secured by assets and cash flows may not be, right? So they can be of both varieties. The next question is from Mr. Ganesh Radhakrishnan, and it's a question which is specific to the Golden Pipe platform. And his question is, how do I know from your portal the type of bond that I have already invested? Question number one, secured. Number two, senior. Number three, tier one and tier two. Well, the way to understand it is actually to go to the filter panel and pick up the options in the filter panel, which is around secured or unsecured, senior versus subordinate, tier one versus tier two. You will be able to figure out which are the bonds which fall in each, which have these features built into them. Apart from that, if you have got an existing bond, which maybe you purchased through Golden Pie or you purchased from elsewhere, and you need clarity, you can share the ISIN number with your relationship manager, and you will get the details regarding the security level, the secured feature, the senior or the tier one, tier two tags that would be present in the bond. Next question. Plenty of similar questions. Okay, it's a question on tier one bonds. It's from Mr. Girish Babu, and he asks, does tier one bonds have a fixed maturity date? What is a call-in date for tier one bonds? Okay, so tier one bonds often come with a term which is termed as a call date. A call date is basically, a probable date on which the bond issuer, which will be a bank or an NBFC, will actually mature the bond and return back the money to you, right? But this is not exactly a maturity date, because this is like an option that the bond issuer can exercise. If the bond issuer wants, it can mature of the bonds, call of the bonds, pay back the money. If not, it can move it, the call date, to the next year or to the next year, right? So that's basically termed as the call date, right? And it depends upon the issuer to exercise that or not. Okay. The next question is from Mr. Pradeep, and he asks, what is senior and subordinate bonds? Please elaborate more. Okay. So this is basically a feature in bonds that kicks in the remote case if the company goes bust, it's not being able to pay. Then what happens is, the money that gets generated by liquidating the assets of the company and, selling off portions of it to other companies, all that liquidation process, whatever money comes up, it has to be used to pay off the debt holders in the company, right? There, senior bondholders whose bonds say they have the label of being senior, they will be the first ones who will be paid. And then if funds are remaining, then the next set of receivers will be the subordinate bondholders. I can give you an example also. There's this DHFL case which had happened, and the NCLT came up with a resolution wherein, as you can see, you'll be able to see the senior secured bondholders were the first ones to receive money 100%, and then a certain portion was then paid off to the subordinate bondholders. Next is, again, it's a question on tier one bonds, more or less answered. Tax on bonds, again, question on taxation on bonds. Okay. a little different question from Mr. Faniraj, and he says, "Can you please let me know how is the liquidity of the bonds purchased with high value? Example, 10 lakh and above. In case if I want to sell." Yeah, so the liquidity of bonds definitely has a direct correlation with the ratings. Higher the ratings, the more liquid are the bonds, and uh, if the bonds are of let's say 10 lakh value, right? Uh, they definitely have some level of liquidity in the market. The only question is like if I'm going ahead to sell it right at the very moment, will I get a buyer and a buyer with a proper price? That's basically the question. Otherwise, triple A rated bonds, double A rated bonds normally come with good level of liquidity. There would always be buyer or interested buying institution, financial institutions who can buy it off from you. Kindly guide on the tax implementation when bonds mature. This is once again from another anonymous attendee. So when bonds mature, what happens is the interest income every year that you'd have got, you'd have to file under income interest from other sources, right? And you'll be taxed as per your tax slab. Now, when the bond matures, whatever is a differential, let's say the bond matured and you had purchased the bond at a discounted price. So actually you're making a capital gains at that point of time, right? But since you already know upfront that this is the gains that would be making when the bond matures, right? So this is something that can get added to your interest income itself. If you have made a loss, you can always offset it with your gains that you would have made for that particular year. So that's how it can be dealt. However, a different tax consultants try and visualize this from different perspectives. Best way would be to definitely get in touch with a tax advisor who can guide you appropriately on this. Mr. Vijay P asks a question, for an NCD, where can I find the record date? The record date is a value which is mentioned in the term sheet or the information memorandum associated with a particular bond tranche, right? You can always ask your RM to share directly the record date or the information memorandum with you, which will have a lot of other details also along with this information. One question from Mr. Kumar Ramamurthy, and he says, do I require valid demat account to purchase the bonds? Certainly. As per the Government of India rules, bonds are already dematerialized set of securities. So all dematerialized securities have to be held compulsorily in demat. Paper formats have gone off long back. So you have to have a valid demat account to be able to purchase the bonds. I'm scanning through the rest of the questions. There's one question on DI slip. Can you please explain DI slip? And this is question from Mr. Suresh Kumar, CS. So a DI slip is a delivery instruction slip. This is like a booklet that is given to you by your demat provider, who in most of the cases is your broker. So let's say my broker is, let's say, Zerodha or Axis Securities, or let's say IFL Securities or Sher Khan, whosoever be it. When I'm opening my demat account, as a part of the kit that I'll receive from my broker, I will have this booklet which will have these DI slips. Now, this DI slip comes into picture when I want to sell off my bonds before maturity. So there, if I see a DI slip, it will have certain data of mine which is to be put in. It will also ask about which is the bond that I'm wanting to sell, the name of the bond, number of units that I want to sell, the date on which I want to sell. I have to fill that up and I have to submit it with my broker for the sell process to go through. Okay. A quick question from Mr. Tarun Patel. Advantages of listed bonds. Well, certainly one of the advantages of listed bonds over unlisted bonds is that you have two avenues to sell it off. One is on the exchange, on BSE and NSE, and number two is you can approach your RM to get it sold off in the secondary market. Vis-a-vis this, for unlisted bonds, definitely because they're not listed on the exchange, you cannot sell there. To be able to sell it, you have to go through your RM or your any other, the stockbroking institution who is taking care of it. In case of Golden Pie, it will be your RM who can assist you in that. And number two, unlisted bonds have a tedious component associated with them. So every interest payment that is paid by unlisted bonds will have a approximately 10% TDS, which will be deducted by the bond issuer and then will be paid off to the person. The person can then claim this and offset it with his annual filings. This TDS concept is absolutely not there for listed bonds. I think more or less we have come to the end of the time that we have for a discussion today. I'll just take one last question and then we'll call it off. Okay, I'm trying to search a very unique question. Okay, I'll take this question. It's a question from Mr. Hari Prasad, and he asks, can you recap on the correlation between interest rate hike and bond yields and benefits for new investors? Okay. So when RBI increases the repo rate, it means the interest rate in the market is going up. Bank loans, rates and all, they will all go up, which will also mean the returns or the interest being paid by bonds in the secondary market, that will also go up. Now in bonds, the returns that they give and the price that they have in the secondary market, the price as in the buy sell price, right? They are inversely related. That means if the returns from a secondary market bond goes up, its price will fall and vice versa. So in this current scenario, because there is an interest rate hike by RBI 50 basis points, right? The corporate bonds would also have their interest that they are offering to the new investors that will increase. Then that is because the price of the bonds will fall. So any new investor who now wants to buy will get the bonds at a cheaper price and at a higher returns, right? Which is like a good thing. So this is like the correlation between interest rate and interest rate hike and the bond yields. They are directly correlated, and bond yield and bond prices are inversely related. So it's already 12 o'clock. We are slightly beyond our scheduled time. With this, I will close off this session for today. Thank you very much for taking out your time and going through with me to understand the various nuances, details around the safety of bonds and various other parameters. I hope I have been able to share something valuable to you to take your first step towards bonds investments. Until next time, see you all. Bye-bye.